We have liked financials quite a lot, although I've taken some money off the table. That's because what's happening is I think you're going to see a consolidation of profits, at least for large private sector banks in the current financial year. If interest rates come down, what happens is their asset book is really getting repriced lower. They will adjust over a period of time with their deposit costs also kind of coming down, but the profit growth will be probably, muted, I would say, in the current financial year, only to accelerate next financial year. So my sense is, given how well financials have done, they are the only conspicuous sector which is at a new high. My sense is that you should lower your expectations on certain private sector banks. Answer your question, I'm very excited about telecommunications, life insurance companies, utilities, digital businesses, so on and so forth. And like I pointed out, with the improving credit trajectory, I think consumer discretionary, like automobiles or some other consumer discretionary items, are also emerging as buy themes for me.
Why do you like life insurance? Growth is just not there. There is no growth.
Sorry, why do I like IT?
No, insurance. IT में भी growth नहीं है, चलो दोनों में growth नहीं है.
नहीं, life insurance में growth है. So fortunately, I'll tell you why I like life insurance. Look, this is a very consolidated business, right? You can see that the top 4 companies which are eating into the LIC's market share are all banks, right? And they are definitely kind of doing quite well as far as both APE, the insurance premiums are concerned, as well as value of new business, which is really, you can call it profits. Both those fronts, they are doing well. The valuations have come down because of severe concerns on regulatory aspects. So surrender value, all of those aspects, there are challenges on bank assurance, whether that channel will get kind of cut for some of these banks. All of those regulatory concerns are now behind us. So my sense is that as you move forward, both your APE as well as VNB, which is top line and bottom line, are going to move very well. And by the way, the valuations have come to very attractive levels. You look at these stocks, they're not done too much over the last few years. So my sense is, with the regulatory overhang coming to a certain point, which is to an end point, now my sense is growth will accelerate for these companies again. And like I said, there's enough market share to grab from LIC as you move forward.
What about general insurance, health insurance? A lot of listed stocks are there now. FDI has been approved, so maybe there could be some triggers and M&A there.
So I'm a little less enthusiastic about general insurance, although I like some companies there. But I would say less enthusiastic, especially about healthcare, given some of the challenges that SAHI, which is standalone health insurance, face. So less enthusiastic about that. Also on the general insurance, which includes motor insurance, etc., I think it requires motor volumes to do well, which I think will as you move forward. And third-party insurance needs to be repriced as you move forward. Having said that, these are all very good franchises, and over a long period of time, they will do well. But in the context of general versus life, I would say my money at this moment is on life insurance.
You said that you've taken some chips off the table in private banks. Why would you do that? Because for PSU banks, the numbers have been okay. I look at SBI, good numbers. I look at BOB, not so great numbers. You are selling a sector where growth, I think, has been quite decent.
No, Nikunj, you're right. I am not saying that I'm bearish on private sector banks. I'm just taking some chips off the table, given how well they have done. And my outlook for these profits of these private sector banks, especially some which have done extremely well, are slightly muted for financial year 26. They will re-accelerate into 27. See, 50 basis points of interest rate cut has already happened. A lot of the private banks that we speak to are assuming another 50 basis points. Some economists actually believe we are in such a deflationary environment that actually you could have a much higher cut than even the another 50 basis points that we are envisaging. If that were to be the case, what would happen is that it would take time for banks to adjust their asset books, because asset books will get repriced very, very quickly because they are dependent on external borrowing rate. So if repo rates were to go down, then they'll have to readjust their asset book quite fast. And which means that their NIIs the net interest income will not grow at an attractive rate. Given that credit costs may tick up a little rather than down as you move forward, my sense is that the profit growths will be anemic for the next year, which is financial year 26, only to reaccelerate in 27. But my sense is, given that these are now at 2.8, 3 times price to book value, my sense is it's good to take some money off the table and allocate it to other places where I see greater value.